Welcome, listeners on iTunes and YouTube. I'm your host, Everson. With me, we have Max and Patrick. And today we have more evergreen content. Some of the topics that we want to talk about is the catalyst, the Volcker rule, solvency. We'll probably get into a lot of debt into the solvency area. And we wanted to talk about the bubble. So with the Volcker rule, I don't know if we have very much to talk about the Volcker rule, but just to shine some light, you want to go ahead and talk a little bit about it, Max? Volcker rule?
Yeah, sure. So this rule was sort of implemented right after the Great Recession, and its purpose was to sort of prevent for another recession to happen. And so the Great Recession happened because the banks were caught with their pants down. You know, they were gambling with all these bad loans, and so to prevent that from happening, basically they had to have more in deposit to cover some of their potential losses, and they couldn't trade with it. But now that we're sort of going to be a little bit more lenient with this rule, and we might actually remove it or part of it, now it's going to bring back into the market about $40 billion, and it's going to actually accelerate how quickly money moves around. Is this a good move right now? Well, the Fed can't reduce the interest rates unless they go to negative. And so this is another tool for them to try to speed up the velocity of money. That's sort of what brings that GDP back, the faster loans, right. And now the banks are actually going to be able to trade in the market with it. And I think Everson has a few more specifics on what they can't do in terms of dividends and buybacks, that kind of stuff. But I just wanted to talk about more money into the markets, more money moving around. The faster it moves, there's actually an equation that can show you that with $1 you can create $7 just by having it move 6 times, I believe. So that's what that's going to do. It's going to accelerate what the banks can do, and we'll see what that does. What I don't like is that this rule, even though right now it might be a good option, it might be a good lever to use, I know that once we don't need it, we won't shut it back down. We won't shut down that valve, and it's going to lead to a much bigger problem later on.
Right. Did you have anything to add to the Volcker rule or any comments to make about it, Patrick?
No, not really. That's not my area of expertise.
Yeah. Well,
all I can say is that Max is right about the Volcker rule, but in general, a lot of regulations was created with this CFPB, and a lot of it is deregulated, especially in the mortgage industry, and that's pretty huge. People have to keep that in mind.
Yeah. So the Feds has also capped dividends, and like Max is saying, and then also banned banks from being able to buy back stock. So that kind of sets them up for success, and I like that. Feds didn't really trend down into the negative like how we did with Alan Greenspan way back when. So I think our position moving forward, as far as the federal government is concerned, they're doing the best that they can. Next topic that I wanted to transition to.
Well, Everson, real quick, did you want to talk a little bit about the dividend situation? With the banks?
Go ahead if you want to talk about it.
Yeah, sure. So now that the market's moving a lot, the banks don't need to give out a dividend. A dividend is an expense to them. And now that their stock is sexy enough because it's moving up and down, it's allowing you to make capital gains on it. They don't have to spend their own money to pay you a dividend. So I don't think that's going to be such a big deal. Later on, when things normalize, they'll bring back that dividend. But right now, they don't need to spend money and give you that. So they're just going to use it for something else. So that's what makes sense to me.
Thanks for giving me a good dividend anyway. So whatever. All right. So we'll transition to the current catalyst. So I wanted to talk about the current catalyst in society right now, especially with regards to investments. I had a question that was asked of me by one of my clients over the weekend, kind of gauging, Max, you as well, right? Kind of gauging where in our industries, or, like we kind of talked about catalysts a little bit on our first episode, or our first recording, What do you think the catalysts are, Patrick? We'll start with you.
Well, Everson, that's a really strong question, but it's a tough one because, I mean, the market is so vast and there's so many forces at play right now that it's hard to pinpoint one. I mean, we all agree that the federal government through the Fed is extremely powerful right now. It has a huge impact on the market. But when we think about different sectors, I mean, for me, the tech stocks are still going to be a catalyst for a long time, just because of the fact that, like, society is changing. We've talked about it on the show many times. Like, I think that the work at home economy and stay at home economy is going to stay for a long time. And what that does is, at the same time, I mean, we've had this discussion privately a few times. A lot of investors are piling in on the stocks right now, the tech stocks. So for me, it creates some sort of iceberg where all of the money is funneled into the same handful of stocks, which is starting to stretch it a little bit thin. So are we in a bubble? Not necessarily, but we're reaching a point where, to me personally, I find it a little dangerous. I feel like the growth is mostly behind us, not ahead of us. It's going to take a while for the market to actually catch up to where the prices are right now, especially if people keep piling on to the same stocks. To me, that's one of the main catalysts that is driving the market right now and that I'm paying attention to.
Right. And we kind of see that change, you're right. And NASDAQ hitting highs as it is in the tech sector, I do
it's
agree
been
that
much more resilient than the Dow Jones, and like the levels aren't going down.
And the S&P 500 as well. We also see a lot of money funneling into the pharmaceuticals and the health sector for obvious reasons, right? So that's still a catalyst even moving forward on short term. After the virus, who's to say, right? So long term, I still think that with 5G technology and everything and the advancement of autonomy driving and all of that, I think the tech sector still maintains its value. For long term, but short term growth definitely I feel like would be the pharmaceutical and health sector.
I agree with you, Everson. And those industries are still going to grow. Just this week, Amazon did some big plays. They're already invested in some electric vehicle companies, but now they just added a new company that's focusing on autonomous driving. So those companies are still going to grow, obviously. But the thing is that there's such a concentration of money now flowing into these specific companies. These continue to go up and everything else is dragged down a little bit. For example, AMD, even though everyone, you and I, we both like AMD, it hasn't had any traction the past few months as people have funneled into other tech stocks.
Right, definitely. I'm going to transition over to you now, Max. What do you think about it? What do you think about this, the next catalyst moving forward? What industries you're looking at?
So to me, the way the market is right now, it's like the show Billions. I don't know if you guys have watched it, but it's Bobby Axelrod against Chuck Rhoades. It's these huge titans, right? And the thing is, they're about the same strength, so things aren't moving a lot, and it's whoever can get the next ally. And so I don't want to get political, but one of the catalysts will actually be during the election. Another catalyst, I'm trying to figure out where it's going to come from. But like you guys, I'm going to piggyback off you guys. You guys were talking about the tech market, but that sector, only the stocks that are benefiting from the process of the virus and the cases, the growing cases, those are the ones that are going to do well. And so the other companies that are actually affected negatively are going to go down, and you're going to start seeing a lot of mergers. So that's how I'm seeing it right now, and that's how I'm analyzing the stocks. It's just those two forces. Right now, it looks, but let me define the two forces. I forgot to do that. So it's Bobby Axelrod and Chuck Rhoades, but it's the massive inflation, the printing of money, the low interest rates, the deregulations that's happening with the banks. That's a strong force. That's going to push the market higher, but it's going right up against basically unemployment. So yeah, you could break it down into the virus, but the virus is just a small part of it. It's creating the unemployment. And so as you have more unemployment, you have less money moving around, And so these two forces are about equal strength as of right now, although I would give the edge to the unemployment. So that's why we sort of broke below a support on Friday, which was really interesting. And we're right above the next support that if we break, we're going back down to the 270s. So hold on to your hats.
I like that. What you both have just said. Two totally different perspectives that approaching what the catalysts are moving forward. And as you said, also Max, I don't like to get political, also, but it's sort of good that we had such high regulatory policy with the Obama administration, because it gave us some leeway now to be able to cut back on that regulatory, like we've experienced with the Volcker rule change. So it's actually a good thing, in my opinion, because where you were profitable, profits go into areas, mainly the government. I think it was like 33%. The companies were paying for in taxes, and now under the Trump administration, they're paying like a 16% tax bracket. So it makes a huge difference for companies. But that fluctuation and change is a good balance, in my opinion. Patrick, you talked a little bit about it, or you mentioned it about the bubble. I wanted to explore that a little more before we get into the solvency. But is there anything moving forward in the future that you see as far as a bubble is concerned?
Yeah, I mean, we've been talking about it. The PE ratios are gigantic, and I mean, that's, to me, the correction. We're trying to be a little bit more evergreen in this episode, but to me, the correction is actually needed to get some prices that make sense. People have been so euphoric into the market because they fear of missing out. They didn't want to be left out as the market like skyrocketed. That it created some situations where companies were overvalued to degrees that didn't happen since 1999.
Right.
And to me, that was very concerning, because it's great as long as it goes up. But I see online, I like to respond to people's questions. I see people that have bought at the peak, and just a few weeks later, now they're left wondering, well, what am I doing? Like I'm down 30% in 1 month. What do I do now? And now they're stuck waiting for the next, like, however many years for the stocks to go back up. So yeah, for me, the bubble is a big concern. I think that the correction is really needed, and hopefully after that, it's going to be more steady incline.
But where do you see it? Where do you see the bubbles sort of forming here in our economy? Or is there any particular sector or any particular industry that you see in class?
Well, we're talking about tech stocks. I mean, the tech stocks, that's the main one to me. I totally agree 100% with Max. It's normal in a sense, because with the stay-at-home economy, these stocks are, they are doing better. I mean, they are having more opportunities. So in that regards, it makes sense. But at the same time, a lot of stocks they're based on 5-year projections that are perfect, like where nothing wrong happens, massive increase in earnings. So what's the upside now based on where we are right now? Like, everything is priced in already. So for me, they're not attractive buys. To me, that's what the bubble is. When it goes down a little bit, that's when we'll see a little bit of upside, where there's going to be some buying opportunities.
How about for you, Max, real quick? What do you see as far as the bubble is concerned? So I kind of talked about a little bit, create some traction, but I talked a little bit about the Fed stimulating the economy as being a potential bubble. But what's your take on it, Max?
So the bubbles that I'm looking at, and so I've been talking about this bubble for quite a while now, and so it's the car industry bubble. How are you going to produce vehicles when people aren't buying right now? So yes, people are still buying homes, which actually really interesting. It's a great trend there. But in terms of vehicles, how are you going to sell used vehicles? How are you going to sell new vehicles? How are you going to produce vehicles when dealerships are having a hard time? And in fact, not only that, but if you go to a dealership, they're not going to give you a great price. which is really interesting, because when you have those contracts with the manufacturers that are saying, hey, we're going to give you another 200 vehicles, are you guys ready to take it? And the dealership's like, well, we still have 250 left from the previous time, so that's a bubble there. And in terms of the exposure for credit cards, in fact, now credit cards are not going to give you a balanced transfer. Why? It's because of that big catalyst that I talked about, the unemployment. And so that's going to create some deflationary forces. And it's just about, we're trying to see the inflation forces are stronger than deflation. What are we going to see there? So a good bubble to probably, get some shorts or some puts is going to be the auto industry.
Yeah, we've seen it in the car rental, with Hertz filing for bankruptcy, that there's a lot of instability there. And what happens when you file for bankruptcy and you have a bunch of cars still on the lot? A lot of these rental car companies, what they'll do oftentimes is they'll sell off older model cars outside. So, you got more sales driving from car rental companies now on selling cars. So they've essentially become a car dealership themselves. Selling off their older models, but
I think that's where they make their money.
Yeah, they make some of their money there. You're right. But doesn't this set up Tesla as a good buying opportunity in the debate that Tesla had a hard time now being able to provide enough cars to their consumer? Now, are they in line now with their thesis? They don't have to worry about overproduction. Are they right at production levels now?
Well, Everson, you're our Tesla guy, so you tell us.
I'm a buyer of Tesla, so I'm gonna buy no matter what direction it goes, unless anything happens to Elon Musk. Then, if something happens to Elon, then that's a problem. But as far as everything goes as transparently as it does, I think we should be okay in that area. But good analysis.
So I'm gonna disagree real quick. So Tesla is part of the auto industry, and even if it's the best of breed, you're not having an influx of cash in that sector. It's actually being siphoned out, going somewhere else. Another place would be utilities, some base metals, and then your staples. That's where it's funneling out to. So I just feel like even though Tesla is best of breed, I'll give you that. It's hard for me to admit it, but I'll give you that. Best of breed right now. It's got a great brand. It's just money's funneling away from it.
Right. I was just looking at the idea about supply and demand. They're right at supply and demand levels now as compared to before, where the demand was so high that to be able to create that kind of production, that was the biggest challenge, which is the reason why we went into China in the first place, was because we couldn't produce enough cars to be able to give consumers that supply. So now that we've sort of balanced everything out, and the problem is on China now as far as manufacturing. So Tesla doesn't really take off too much of a hit, I think. If it comes to overproduction, that's China's problem right now. If it comes to overproduction, because they're the one with the $100 billion into Tesla. But that's a big topic. I want to transition out of this topic and go into solvency. And with solvency, just real quick, let's talk about solvency with versus liquidity, and what's your take? Transitioning back to Patrick again, what's your take on that? I mean, companies in the short term or even on the long term, are we at good levels with this? Are we good levels of solvency?
I mean, there's never been more liquidity in the market, so that's it's kind of interesting, because on one hand you have companies that are really pressured, their earnings are down, so it should make it more difficult to raise money. But on the other end, the interest rates are super low, and you have the Fed pumping money into the economy, buying bonds, which creates, make it more easy massive opportunity to raise money. So it kind of balances out. So I'm not too worried. I'm kind of shocked and surprised that Hertz is one of the only companies that didn't get bailed out, to be honest. It's kind of hard to understand, because every other company, it's like the Fed is, there's a backstop making it so almost no company has gone bankrupt. Like, can you name a few that have been bankrupt in the past few months, even with this massive crash? There's very, very few, surprisingly. So
Yeah.
I'm not that concerned about solvency for most companies, unless it keeps dragging out and then everything in the travel industry is really vulnerable, and in the entertainment industry, as we've talked about many times. So those are the most like vulnerable ones, but in general, most companies aren't too in danger.
How about for you, Max? What do you think?
So when we talk about solvency, that's basically fundamental analysis. You're trying to identify, is this company here for the long term? But the problem I have with that is the way I'm seeing the world right now, the market, is that if you're making transaction, if you're investing based on fundamentals, you're too early. If you're investing
Right.
on news, you're too late. And so if you're investing on technical analysis, which would be the charts, then you're right on time. So let's go back to solvency. And it's sort of what Patrick was talking about. That doesn't mean anything. First off, it's fundamentals, which means, you're sort of projecting far in the future. But the other thing is, like Patrick was saying, the government's printing money. So it doesn't matter what's happening. If you're going below, if you're spending too much cash, whatever it is, hey, the government's you're back and they're just going to print a few bucks for you. So solvency right now is not a big deal. But you're going to see some big solvency problems, like I mentioned a little bit ago, in the auto industry and especially in financials as well.
Right. I like
Just
that
like
when you-
I just like to add on something to that. I agree with you for the most part, except for me right now, and I think everyone should do that. The first question you have to ask yourself when you're looking at a stock is, what are the odds that they'll go bankrupt in the next year because they don't have enough cash and they can't raise cash? So you won't necessarily see that in the chart. Like, you have to look at the company and what their opportunities to raise money is, and
Right.
the rate that they're burning cash, especially right now in the crisis when they can't get as much revenue as they normally do.
Yeah,
It's
24-hour
all right.
fitness
They'll
is
just
another.
raise some cash overnight. It's not even a big deal today.
Well, what about 24-hour fitness? I mean, it's not like they could really necessarily raise cash, and it's a prime opportunity for the coronavirus to be able to spread in an environment like that, right? So they're still charging the same price for gym membership, but you got to call in to be able to, they need to know how many people are coming in. You only have an hour to work out. You can't use the showers. You can't use the pools. I don't even know if you can use locker rooms. Like, they're taking away some equipment. As you may or may not already know, 24-hour fitness is filed for bankruptcy, and they're closing 100 stores, or locations. So it's like, that industry is going to shrink big time. And as we saw with Nautilus Brands, I think it was, that's Bowflex.
Yeah.
It was, you can't even, you go on eBay and people are selling their Bowflex equipment for 200, 300% the value. So
yeah, I was looking on the website and everything was sold out for a while because they just couldn't meet the demand. Everyone's building home gyms.
Yeah, so we could just give you a couple of stocks right there to go ahead and invest in. So I wanted to close real quick with talking about a question that Max brought up, which was, what is better, earnings per share or price to earnings? And Max, because you came up with that, why don't you just lead that since you came up with it?
Yeah, sure. Put all the pressure on me. So price to earnings, PE ratio. I mean, you can just flip the channel on to CNBC and you'll see they mention that very often. A great way to measure a company is your PE ratio. Is it high? Is it low compared to its competitors? Well, what about earnings per share? Have you ever heard that term before? That ratio. To me, PE ratio is to show me, is this a good price to buy this stock? If you don't know how to analyze stocks, if you're not paying attention to the news, you're not comfortable with this stock, then all you have to do is look at the PE ratio and look at the competitors, and instantly hey, you know what? This is a pretty good price for, this industry. But earnings per share, if you're looking at the past 3 quarters, you can actually see a trend. Are the earnings going up, going down, sideways? And so you can tell, hey, is this company growing, shrinking? because if I'm investing in a stock, long term, which I don't usually do. I haven't invested in a stock since like 2015 or whatever. I do more calls and options, that kind of stuff. But so what you're looking for is a company that's growing, and so earnings per share to me is a lot more important than PE ratio, because PE ratio, I could just figure that stuff out looking at the charts.
Right.
But to get a good temperature of the growth, the potential future of this company, earnings per share for me is a lot more important, and nobody talks about it.
Nice. Patrick, you got anything to add to that?
Well, I disagree a little bit, as usual, just because of the fact that people talk about earnings all the time, and if they beat analysts' expectations or not. But other than that, I agree with Max.
All right. So as far as my perspective on it, it's interesting perspective. I neither disagree nor agree. I probably agree more than disagree, but I haven't really looked at it at that perspective of earnings per share. Like Max has said, it's always a topic of conversation to talk about a PE ratio. So everyone's talking about the PE ratio. They're not really talking about their earnings per share. But if there's anything that I know of Max, he always puts it to perspective where you start to think a little differently. I think it was last week, but not last week, but this week, you had said regarding the approach of your thesis and looking at investments, you sort of do a reverse analysis of why it should go up, or if you're betting on the stock going down, why should it go up? If you're betting on a stock going up, why should it go down? So you want to talk a little bit about that?
Do we have time for that? I mean, that's quite a subject.
It'll be a last topic. It'll be a last topic.
Okay. So I like to reverse engineer things. First, I think I've already said this before, that I try to look at the three directions for any position I go in, whether it's calls, puts, stocks, you name it. I want to make sure, hey, what's going to happen to my position when it goes up, when it goes down, and when it goes sideways. And to be honest, a long time ago when I first started out, and I guarantee you about 90% of all traders, all they care about is, hey, I'm going to get into this position and it's going to go up and I'm going to make money. Okay, but what happens if it goes sideways? What happens if it goes down?
Yeah.
People don't like to think about that. And sure, you can call it negative, but you also have to analyze your risk and what's happening. And now the other thing is, when I create a machine, when I create my rules for how I'm going to trade, I want to back test it. Why? Because I don't want to prove why it's right. I want to prove why it's wrong. Why is this system, the way I'm going to trade for the next, who knows, 3, 4, 5 weeks, why does it not work? So I back test, as thoroughly as I can. And that's what science is. Science is not there to prove something is right. It's there to prove something is wrong. So you have a thesis and you spend a lot of money, a lot of time trying to prove that thesis is wrong. So if I say, hey, anytime I see a bearish engulfing pattern, I'm going to trade that. I want to make sure, hey, I'm going to go back test and make sure, hey, that's actually not going to work. And when you thoroughly back test it and you're like, oh crap, I couldn't disprove this theory, that's a pretty good trade to do.
Real quick, I see a lot of smiles over there in the corner. Patrick, you want to add something real quick before you close?
Max, everyone knows stocks only go up.
Oh man. Oh man.
Well, I had fun with this podcast episode. We're at a close here. Thank you for tuning into our midweek podcast episode. I hope you enjoyed it. Please go ahead and subscribe and leave a comment below. Follow us on Instagram. All of our information would be on previous episodes, and I think maybe even we'll be listening it on this post also. But I had fun. Take care, you guys. Have a great rest of the week and stay on the green side.